Okay, so I'm going to start. So hello and welcome everyone to our session on the role of finance professionals in accounting for financed emissions. My name is Kerry Perkins. I head up our capital markets at A4S, Accounting for Sustainability. And I'm delighted to see so many of you on this webinar. We had a lot of interest in this webinar. For that purpose, we have also decided to record this session, and I believe this was included in the pre-session communications to you all. And this will be then added to our website as a learning resource for others. So the aim of this session is to explore the role of finance teams in supporting their bank, as well as their counterparts in risk and sustainability in the financed emissions accounting process. And we will be looking at the practical steps, the challenges faced, and some top tips. And I am delighted we have some great presenters today to share their experiences and insights. So I'd like to make a special welcome to Supriya Sobti from NatWest Group, the Climate and Purpose Lead, Mike Newby-Fraser, Group Reporting Technical IFRS and Sustainability Lead at Standard Chartered, Justine Bolton, a Carbon Management and Climate Resilience Specialist at First Rand Bank, and Alex MacGillivray, Director of Development Impact Evaluations at British International Investment. So we will have plenty of opportunity for Q&A, for questions, and we encourage you to get involved and ask lots of questions via the chat function that's been set up. So just quickly, briefly, for those who are not aware of Accounting for Sustainability, A4S, we were set up in 2004 by the Prince of Wales, and we work across the entire finance and accounting community around making sustainable business as usual. We work closely with the CFO and finance community to inspire, transform, and scale up an integration of sustainability into decision-making processes. We have run a few of these sessions on this topic last year, and these recordings can also be found on our website. And we also published last year a practical guide for finance teams of banks on net zero, alongside some case studies, which we encourage you to also look at, and we will send links to this in the post-session communication. So now straight on to the first part of this session, I'd like to invite Supriya from NatWest to share with us NatWest's approach, their challenges, reporting, and specifically on the role of finance, along with next steps and top tips. So over to you, Supriya.
Thanks, Kerry, and good morning all. So I'll just, as Kerry mentioned, I'll just speak a little bit about our journey on financed emissions. If we can move on to the next slide, please. So I guess this is almost where did we start. So NatWest set up its climate ambition in 2020, and we said we would reduce our emissions on financing activity, which is loans and investments, by 50% by 2030. So that was quite a challenging ambition that we set a few years ago. Because we started our journey then, we have analysed about 52% of the balance sheet as of 2019. In terms of assessing our emissions estimates, and then we published those in our 2021 accounts as well as 2020. Some of the other ambitions which support the achievement of kind of how do we get there are also laid out on this page. So we said we would provide funding and financing, sustainable climate funding and financing of 100 billion by 2025, of which we'd already done about 17.5. We also want to be quite ambitious about our own operational footprints and not just work with our customers, but also our own operational footprint. And we said we would reduce that by 50% by 2025, which is for our operational chain, as well as phase out of coal, etc. And overarching to that is the net zero by 2050, which is aligned with the Net Zero Banking Alliance and GFANS and all the other work that's going on. So this is sort of where we started and the journey we are traveling on today. So in a little bit more detail, what have we done so far? So if we move on to the next slide, as I mentioned, we've looked at 52% of our balance sheet, which covers approximately 12 sectors. Some of them are quite large, so mortgages is a big part of our balance sheet. So I wouldn't be fussed about the numbers of sectors, but it's more kind of, we've looked at 50-odd%. And we've tried to be quite transparent in our disclosure. So we've published absolute emissions, so scope 1 and 2 emissions, which is tons of carbon dioxide equivalent, as well as scope 3 for the sectors that are relevant. Also physical emission intensity, as that is a metric that we think is quite good in analyzing emissions for a certain sector. So for mortgages, it's emissions per square meter. For the transport sector, it's per kilometer. So that really kind of tells us what we need to do in which sector and which sectors need more work. Then we have economic emissions intensity, which is emissions per pound million of lending. And again, that's a useful indicator in terms of, how much carbon is every pound generating in a certain sector. And that gives us guidance as to what we need to do. And obviously, I can't not mention data quality, because I'm sure a lot of people on this call are dealing with data quality issues related to emissions. So we follow the Partnership for Carbon Accounting Financials standard that was published around 2019-2020. And we use that, and that has quite a useful kind of data quality score metric, which we use internally as well as published externally, just to remind ourselves that this is a journey. There are imperfections. But rather than wait for everything to be perfect, we've kind of started off. So we do publish our data quality score as well. Alongside 2019, and I mentioned at the start, we have our 2030 ambition. So we have also signed up to the Science Based Targets Initiative. And we use their kind of tools to assess what our 2030 position should look like. And we have submitted our targets for validation for SBTi as well. So that's sort of the journey we are on and where we are heading. So on the next slide is what our disclosure looks like. So what does this mean from a disclosure perspective? And as you'll see on the left are the sectors that we have covered, and where there are specifics within a sector. So land transport has, road transport, rail, as well as passenger transport. We've tried to split it out. I guess we find it quite useful internally to differentiate as much as possible, so we can identify where we need actions and what type of actions we need. So we've done that for 19 and 20, and kind of on the top, you'll see the metrics I talked about. And on the far right, you see where we want to get to in 2030 to get to our halving the climate impact of our loans and investment activity. So this is just one way of presenting. I think some other banks have done charts and all that. So I think presentation doesn't matter as long as you kind of put in the thought as to how much do we want to publish and be a little bit ambitious as to what you can cover. So if we move on to the next slide, I guess that's where we start talking about the methodologies. So this is a very simplistic portrait of what we have done. So for commercial real estate and mortgages, we have used EPC, so energy performance certificates, for assessing emissions, because that's kind of the best available data at this point in time. For commercial sectors generally, what we've done is, where possible, we have tried to use our customers' emissions, right? So we looked through kind of their accounts, we saw what external data was available and used that. So where possible, that's our first sort of point of data use, right? As to what is our customers' emission and what is NatWest's share of our customers' emissions. When emissions aren't available, we then move on to other publicly available data. So we use production data. So, if a certain factory has a production capacity of, how many ever units, and then what are the emissions related to those units and how much was the production in a particular year. So we try and use other published data to derive emissions. Production is again our first port of call, because that sort of tells you the capacity and the use of the assets we are financing, right? If we don't get that, we use revenue. So obviously from revenue backward calculate production as much as you can, and then emissions. So as you will see, we try and use as much publicly available data as possible to try and get a sense of emissions. And where we use revenue, we then kind of try and work back from revenue intensity as well. And where none of this is available, so we have a lot of customers who are, small customers, we have SMEs, and they don't always publish accounts. Even kind of some of the smaller corporates don't publish accounts. And in those cases, we have to use estimates. So where they're in a certain industry, where there's industry data. So for say transport sector, we were able to, or rail sector, we were able to get kind of rail data from the TfL and other kind of other bigger websites. And then we used some of those to derive kind of the kilometers and then emissions, etc. However, there is a small percentage in every sector where we just don't have data, and then there we extrapolate the emissions of rest of the sector to get to the emissions. So the next page will show you what it actually means, right? In terms of what does it mean? So that table you see, the columns are where did we have publicly available emissions data. The third column is where we use production revenue data, and then the last from the fourth column. And then you have the estimates, right? So you will see we have used this to then say what is our data quality. And as you will see, so just to introduce PCAF data quality, it ranges from 1 to 5, with 1 being the best. So where have we used publicly available emissions data, and 5 being sort of estimates, etc. So the more you have in 1, the more stable your emissions calculation, etc. are, and more reliable your data is. And the more you start heading towards 5 is where there's a lot of use of estimates, and estimates may change. And as you will see, right, we are 4, 5, 2, 3, depending. Different sectors have different kind of data quality, and some of the ones I've circled are close to 5. So agriculture, say for example, these are farmers. They don't always publish accounts. There's not a lot of available information. We've had to use kind of proxy data that was available to estimate emissions. So we do recognize internally, and we want it to be really transparent externally, that this will enhance over time as more data becomes available. And NatWest is doing a lot of work with Sustainable Food Trust and other areas in terms of how do we actually help farmers enhance that data, because then we can actually know how much emissions we have, rather than like estimates that we have just now. So as I said, this is a current sort of challenge. And as I said, I can't talk about finance emissions and not mention data challenges. But I think the stance we have taken is acknowledge the data challenges, still do the work, still do disclosures, but be really transparent of the approach we are taking, what our data quality is. And we use PCAF score, you may want to use something else. And then also sort of what are we doing to enhance the data quality, but then kind of include the necessary sort of caveats, etc. in terms of, this will enhance as better data becomes available. So we work quite closely with our legal team, because obviously, as you can imagine, there are challenges in terms of what if someone just says this is the end point. So we work with our legal colleagues to make sure what we are publishing kind of has the right caveats, etc. Some of the other challenges, so if you move on to the next slide, as I said, we follow the PCAF standard. PCAF standard currently asks us to calculate emissions on all balance sheet exposures. So they use the follow the money concept. So unless you have given money to someone, they're not using the money and hence not generating emissions. So because we are using that, and because certain industries and sectors are seasonal, also, the demands of certain customers may change from time to time. What this does is it brings in a little bit of variance, depending on, when you are calculating emissions and how much the drawdown of the customers is. So we are looking at this as to what to do. But when we publish our accounts, this was something we called out as to, and then this is where we can set a target, but sometimes emissions will just go up because customers have drawn down more because they needed more money for whatever things. And I think that's where we are just working internally as to how we take away that sort of variation that comes in. But for now, we just wanted to be clear about that. The other piece is, as I mentioned, sometimes we're using customers' revenue, sometimes we're using customers' production, sometimes we're using kind of other data to estimate emissions, which may have nothing to do with emissions. So, a customer's revenue may fall because of something totally different to emissions. They may still produce as much, or similarly, it can rise because of a one-off. But if we are using that revenue data, it will impact our emissions. So this is where the imperfections in customers' data, the lack of granularity of emissions data not being available causes these sort of variances. And as I said, sometimes we have had to use intensity estimates, particularly to look at revenue and kind of work back to emissions. And because some customers in a sector maybe, have a lot of balances and others may have like small balances, it can cause, again, the average for the sector may not actually reflect every customer, but that's always the case when you use averages. The last one I've got, which is actually quite significant, is the methodologies, right? So we are using PCAF, we're using SPDI, but even in SPDI, a lot of sectors don't yet have methodologies. So that was the reason why we went with the 12 sectors we went with, because we had SPDI methodologies for those. As SPDI continue to work on further methodologies and PCAF standard develops, we will continue to develop our calculation. So I think what I want to show through all this, which I've kind of said already, is that it's a journey. So we're using the best tools, the best data available to start doing something, because calculating emissions is the first step. The next step is, what do we do about it? How do we reduce? How do we plan? And I guess before I move on to next steps, I'll probably touch on the finance team's role. So if we move on to the next slide. So what are we doing in terms of finance? I sit within finance. So we started off with being a part of a bigger team led by strategy, because this was a strategic kind of thing when we launched our strategy in 2020 in terms of calculating emissions. But over the years, we've tried to make it as business as usual as possible. So finance now lead the calculation of finance emissions and the measurement framework. We work obviously with various areas in the bank. We work with strategy, center of excellence, climate center of excellence, business teams and other teams, but we're trying to make it as BAU as possible. As accountants, we obviously need a good control framework. So we are again working with, data is imperfect, but whatever data we have, what is the lineage? What's the control framework? How do we make sure, we have the right controls in place to make sure our outcome is right? We're also putting in processes in place to review both our inputs and our outputs and sense check what's going on and make. So I guess we are not seeing this data any different to any other balance sheet data, right? So that's the mindset we are working with. So RWA, the same controls you have on other processes, we are working to apply that to this process. We're also developing management information, because this is a metric that the bank as a whole isn't too familiar with. It's the same as when capital came in or Basel came in and we had to educate everyone on RWAs. We're going through that same journey on climate. And we feel that good management information can play a very strong role in that. So we are kind of generating as much as possible, sharing it with people, going through a massive education exercise so that people can start using this data in decision making. And so finance also lead the production of TCFD, so a climate report and alignment with it. So that's going on. And then we help investors in ESG surveys. So just quickly on last steps before I wrap up. So the next slide kind of lays out what's next in our journey. So we had our AGM in 2022, and we put forward our first Say on Climate resolution there, which included our intent to publish a transition plan to show externally what we are doing on our climate ambitions. So we are working on producing those transition plans internally so we can then publish externally next year. And as I said, as part of doing that, or a big part of doing that, is how do we think about climate as part of our decision making? So the education, the MI, and all that work I mentioned, we are going to every business area and sectors to kind of say, what can you do more for customers? So there's a lot of work going on with the actual people who deal with customers, so we can design products to support their transition. And obviously there's continuously work going on the climate report. And then we're also working on the data piece as to how do we make it better? How do we enhance our methodologies of internally kind of calculating emissions so we get to the answers we need. So I guess just as I wrap up, as I mentioned, it's a journey and calculating emissions is the first step. So I wouldn't be shy about calculating emissions, because once you know your emissions, I guess then the hard bit starts in terms of what do you do about it? How do you reduce emissions? How do you work with your customers? So, and I think that's the exciting part as well. So I'm happy to take any questions when the slot comes in, but I'll hand back to you, Kelly.
Thank you so much, Supriya, for doing a whistle tour of this. Really, really appreciate this. And I've sent out on the chat function to invite people to send out questions. We're going to go straight to Mike next from Standard Chartered, and then we're going to do a bit of a Q&A session with both Supriya and Mike. So please do think about the questions you might want to ask specifically to Supriya, and likewise for Mike, and send them through the chat function. And then we will collate them all and ask them during the session. So with no further ado, I'd like to ask Mike to step up to the virtual platform and present very, very similar on the topics that Supriya covered. Thank you.
Thanks, Kerry. Thanks, Supriya. So we always, whenever there is a climate-related discussion, it's always good to have a bit of a climate graphic to start off to just get everyone in the right mood. So we'll start on there. So finance and climate-related disclosures. So on to the next one, please. So basically in finance, and I think for any financial organization, if we want to simplify, and a lot of what I'm going to talk about is trying to simplify the message. So get the message out in a clear and concise manner in which sort of your average user can pick up your financial statements, or as Supriya noted, your TCFD, and try and understand what you're doing as an organization. So for any finance organization, I believe there are 3 steps to climate change. The first is banking the transition, so accelerating sustainable finance, and that is providing finance to your clients and to society in order to change from a fossil fuel to a non-fossil fuel society. So that really goes into sort of your opportunities. Your second piece is your net zero, so your net zero journey, and we will hear journey a few times. It's a cliche, but it is a very apt one. We are talking about a journey up to 2050, different on the way, but it is a long-term journey, and so it will improve over time. But net zero is basically, as Supriya mentioned, you look at your sectors. We started with our high carbon sectors, understanding what those emissions are, and then mapping out pathways to get to net zero by 2050. And then the third piece is managing your climate risk. So it's understanding what that climate risk is, which generally for banks will be your transition risk on your wholesale portfolio, and then your physical risk on your retail portfolio, primarily on mortgages, and understanding what can be the impact for you basically on a go-forward basis today and on a go-forward basis.
Sorry, Mike, just to interrupt, you're breaking up a little bit. Could we ask you to turn your video off and see if that works better?
Yeah, sure. Let's try now. So yes, as I've said, there's basically 3 pillars which I generally look to. We're going to talk the most today about the net zero journey, which really is your financed emissions. But all 3 sort of are play a part with each other, both on an opportunities for banks, because obviously transition finance, so banking customers to move from that carbon sort of underlying to a non-carbon future is a great opportunity for banks, but it also represents large risks for your current portfolio. And those have to be understood and managed. And that's really where your net zero journey comes in. So moving on to the next slide, please. So when I think about finance principles, and again, what we have seen is that the climate journey, as has been told, we've seen from ourselves and a lot of our peers, this really started a few years ago with often the communications or the marketing teams. And it started with probably improvement of companies' brands to be good corporate citizens, and the control aspects have probably not been as tight as one would want. So where finance have come to the table, and finance have come to the table in different parts of this process for different organizations, it really is getting back to the basics. So we look at sort of, we're trying to embed controlled quality publications and less publications, but better quality. So trying to integrate as much as of your story into your annual reports as possible, and really having control and reconciliation back to your annual reports. So something as simple as when you're working out your financed emissions, when you work out your exposure to clients, does that basically balance back to your balance sheet, so your loans and advances to customers? These are simple things, but really make a difference, where you have proper reconciliations between your annual reports and then other publications which you give, and where there are differences, noting those differences and being consistent. So explaining your year-on-year variances, and then explaining if there are differences to your annual report, and that often your reporting dates will be different. There often are lags in the timing of information that you will get, such that not everything will be at a year-end date, and that just needs to be explained. So Supriya was noting, we need to be clear with the users, and that's where I think sort of definitions play a really important part in this journey, because this is not an exact science. And you have to be, when I talk about concise, we have the UK Corporate Governance Code, fair, balanced, and understandable. So you have to write your story in an understandable manner, which is fair and balanced. And when I talk about balance, you talk about your achievements, but also what your shortfalls are, and basically pointing those out to your users in a clear manner, which is often where the legal teams do come in, because they like to give sort of pages of sort of legal, I guess, where they give legal outs for you, or safe harbor provisions within your accounts to say, there will be errors, and these, well, there will be errors, or sort of your estimates may materially move over time, but that's all part of the journey. So basically a move away from marketing into a controlled, concise if possible, and consistent narrative to give to the market over time. So next slide, please. So in group finance, when we talk about sort of making the transition, I'll go on to this sort of briefly. What this often is really tagging your asset portfolio as being green or sustainable. And in the context of climate, it's really green. And so it really starts off with the United Nations has 17 Sustainable Development Goals, SDGs. There are also various taxonomies that are coming out. The EU taxonomy is probably the one which we look to the most. And what it says there is that there are various hurdles which you need to jump over in order to tick an asset as being ESG or green. And basically, once you jump over those hurdles, you have a green asset, and that forms part of your green asset portfolio. Revenue which is generated from that asset, normally in the form of interest, becomes your ESG or your green revenue. And then you also have on top of that, where you have fee-based income, such as underwriting advisory, for instance. The total of the interest plus that is your revenue. Again, I can't stress enough, definitions matter. To be clear to the user as to what is and what is not within the scope of what your asset growth is. And then also sort of just explaining your journey. So what you will find is that most banks do not have large organic growth of their green business. What they do have is identification of their existing portfolio, and basically a tick box approach of a lumpy growth of assets. For instance, we've just managed to tick our green mortgages. So where, for instance, our mortgage portfolios meet certain energy ratings, we count those as green. That's an incremental sort of increase in the assets that we have. So you'll see a lumpy growth in ESG assets being reported as basically the hurdles are jumped over by banks reporting. So on to the next slide, please. So net zero, basically here is describing, I guess, the start of our net zero journey. And we issued a white paper in 2021, which referenced 2020 of our net zero journey. And much like NatWest, but probably not as detailed as them, we have a moratorium on coal, and we will also sort of phase down all coal lending to counterparts who are reliant on coal for their revenue over time, which is in the top right-hand corner there. We also have basically 3 of our highest carbon emitting sectors, which we provided a deep dive into, as well as forward-looking pathways. So those are oil and gas, power, and metals and mining. And what we did is we looked at our portfolio as a whole to get a baseline set of financed emissions. So where we basically finance our counterparties' emissions to get a total tonnage of emissions, which is 45 megatons of CO2 equivalent, as you see in the corner there. Again, this is not without complexities and not without shortfalls. Data is, as always, very difficult, especially for an emerging markets organization. We are in 57 markets. The majority of those are emerging markets. The data is not always there. And so when we talk about a journey, it very much is a journey as our clients start to disclose on their own, and as we really push them to disclose. So we reached out to our top 2,000 clients last year, basically giving them a questionnaire of basically to self-certify, to really push them to disclose their carbon in various forms, whether it's bilaterally with us or in the market with something like the Carbon Disclosure Project, CPD, and really sort of over time, as that information that we get improves, so will our reporting improve. So the caveats which legal put into all of these disclosures will say that, you know, these will improve over time. But sort of bottom left-hand corner here, you'll see the pathways which we put on. So what you do is you work out your exposure to clients, you work out your ratio of how much you've lent to them, and then you work out a forward-looking pathway. And so we use the International Energy Agency's pathways. So net zero emissions, which will show sort of your emissions tailing off over time. And then we also will look to see if we just use our current policies, which is the 3.5 degree scenario, where we end up. I think what I'd probably like to point out here is that obviously the journey for emerging markets will be greatly different to the journey of advanced markets. It really is a first third world viewpoint. And you can't apply advanced market thinking to an emerging markets profile. It's not fair. We talk a lot about a just transition, and what part of our job of financing and disclosures is to basically educate the market on what that means. And that means that we will need to finance emerging markets a lot more. And it may actually mean that the carbon that we finance increases in the short term as they transition over. For instance, if you think about a coal-fired power plant, if we transition from that to a diesel fire, from a diesel to natural gas, from natural gas to renewables, all of that takes money and will have a carbon impact, which may increase in the short term while it goes down in the long term. Okay, on to the next slide, please. So when I talk about the net zero journey, I think about it in 6 stages. The first stage is basically your loans and advances to your corporates. We exclude sort of loans and advances to financial institutions, because then you'll just end up sort of double counting, as you double count the financial institution who then lends to the corporates. There is double counting all over the show here, but it is sort of the nature of the beast. And we are trying to sort of, I guess, change the thoughts and the actions of our counterparties and of our clients. So it is something that's well known. Again, it is just something we have to explain. So basically, where we are at the moment is we have looked last year at oil and gas, metals and mining, and power. This year we are looking at our transportation, so aviation, shipping, and road transportation, doing deep dives into these sectors. So basically, the first part of this is working out what your exposure is to these counterparties on a counterparty by counterparty basis. The second step is working out what the counterparties, what they call the enterprise value or the EVIC is, which basically is your net asset value or your listed debt plus your equity. For a listed company, your equity is your market cap. Again, as Supriya said, a lot of these terms come from PCAF, which basically EVIC comes from. People will say, well, if you use a market cap, again, sort of your denominator in this equation will move. Yes, it will, absolutely. In the same way as Supriya was sort of talking about, where you use an emissions intensity, which looks at revenues, again, your numbers will move on you. The easiest example of this is if you look at an oil major, such as BP, for instance. In the current year, BP share price has increased about 100%, which means that their denominator increases. Also, the price of oil has gone from almost negative 18 months ago to $120 a barrel, which means that sort of to the uneducated eye, you think, oh my goodness, the carbon has basically gone down 4 times per on a revenue basis, but all that is economics and the price of oil going up per barrel. 1 barrel of oil equals the same amount of carbon for that grade of oil. It doesn't matter if it costs $0 or if it costs $120. So these are known problems, but they are ones that just have to be explained. And again, that we are on the journey. Emissions intensity may not be the best marker. However, sort of it is starting that journey, and it is where we are now. So moving on to number 3, basically, SCV, so Standard Chartered's exposure divided by the EVIC, basically is the ratio of your financing provided to the organization as a whole. I lend $1 billion to BP, their EVIC is $5 billion. I've basically funded 20% of their organization, and that becomes the ratio of their greenhouse gas, which I will basically claim as my own and disclose. So the fourth point of that, greenhouse gas emissions data by the client. Again, as Supriya said, this is where there are gaps. So there are gaps basically in getting the EVIC numbers, especially for your smaller clients. There are also gaps in getting the carbon data from clients. So what we will use is we will use third-party providers such as Standard & Poor, Trucost. We'll also have bilateral outreach. And then what we also find is that where a client is in a certain sector, you can use regression analysis or analytics to work out what their emissions are. If, for instance, ExxonMobil doesn't want to tell us what their carbon is, we can work out how many barrels of oil they've pumped, and we can sort of regress back to an answer there. So basically, greenhouse gas ratio times by the greenhouse gas gives you your financed emissions. And then you tack on a forward-looking pathway, and that gives you your net zero journey. Just at the top there, of course, you can have an absolute financed emissions, which is basically the ratio of your outstanding exposure divided by EVIC times by the total emissions, or you can have a revenue-based intensity, which I spoke about, which brings in basically a dollar cost or a pound cost per carbon spat into the atmosphere. Okay, next page, please. Just very quick on risk identification. Obviously, we have your transition risk, so the risk that your clients on transitioning from a fossil fuel to a non-fossil fuel revenue stream will not be able to pay you back your loans. That is the biggest risk for us. You also have physical risks, which is primarily seen in your mortgage portfolios. And we're a little bit more advanced on that. Most people that have bought a house will know that there is a flood report that is done on that already. Banks will generally look to those, but sort of more work to be done. We also will disclose our gross exposures to high carbon sectors in our TCFD and increasingly in our annual reports. Where is this going? Obviously, eventually, sort of your actual carbon or your climate impact will be in your expected credit loss calculations. We're not quite there yet. What we often find for ourselves, for instance, is our book is about 5 years or less, whereas a lot of climate risks are over sort of a profile up to 2050. So this is where you have sort of short, medium, and long-term impacts and forward-looking impacts that come into play. All right, next slide, please. The last thing I'd probably say is economic realities matter, and obviously sort of we're all on this journey, but where you have something like a Russian invasion takes a lot of oil and gas supply out of the market. The question will be, you've seen Germany switching back on their coal-fired power plants. How does finance react to this? We have ROTE or ROE targets which we have to meet, and if you are also an emerging markets bank, you have to bank that transition in the emerging markets. So it is no good sort of having a moratorium on all power plants if it switches off the lights and stops education. So there are other factors to consider, including economics, which comes into this journey. I think that's the last slide, or was there one more? Just we have the next one, please. Yeah, so I guess just the reporting requirements. These are evolving very fast. In the UK, we already have Section 172 of the Companies Act, duties of directors to promote the business, and within that is basically the company's operations with the community and environment. So we already see this in strategic reports. This will grow more and more. TCFD, which is the Task Force on Climate-Related Financial Disclosures, provides financial disclosures generally as a standalone document. HSBC put that in as a document within their annual report. They did it really well. I think more and more banks will do that. The FCA came out sort of a couple of weeks ago with new guidance to say they expect TCFD type disclosures to be within financial reports by 2023. So I think the direction of travel is there. We obviously have the new ISSB standards under the IFRS Foundation, which bring in TCFD, and then also what's called the SASB disclosures, which provide more granular sort of, I guess, disclosure requirements on a sectoral basis. But this is the direction of travel where we are going. It's not getting, my personal view is this is the new sort of expected credit loss, or ECL, yeah, not perfect, but we're on the journey, and we're getting there. So I think that's it from me. Thank you.
Oh, thank you, Mike. That was brilliant, and really, really clear, the process that you take. So thank you very much for taking us through that. So we're going to just open up for questions. I have a couple. This is for Supriya and Mike to answer. So please, during this session, please feel free to add any more questions to the Q&A section. And we'll do our best to answer those in the time that we've got. So just first of all, I think what would be great is just kind of like stepping back, because a lot of people on this call, from the conversations I've had with banks, a lot of these of the finance team, is just a really simple question about how you got started, how you got the buy-in, who you got the buy-in from. And I'm talking specifically from the kind of finance lead on this. How did you ensure that, you know, finance played a significant role in this, and what kind of obstacles did you have to overcome? And I wonder, Mike, could I ask you that question first, and then Supriya, if you've got anything to add afterwards.
I was hoping Supriya would go first. I feel like sort of they're further down the journey than we are.
Well, maybe then
look,
it's newer to you then, so fresher in your memory.
Yeah, no, I mean, it's good. So what I've found, I think, in the past 18 months is you've had a bit of a slow burn, which has sort of rushed on us relatively quickly. And finance has really sort of at our organization got involved in, quite honestly, that sort of time frame, the last sort of 12 to 18 months. What we found is that
sorry, Mike. I just
again.
Yeah, it works perfectly when you don't have your video on. Although, as much as we'd like to see you.
That's great. I think what happens is where you start to have mandatory disclosures, finance starts to get very interested. So TCFD has become mandatory for UK premium listed companies as of the end of last year. We've also just seen a lot of our shareholders and NGOs start to ask a lot of questions, and the control aspects have really been on the agenda. So sort of at year end, our auditors, EY, we're very interested on what are the climate impacts on your balance sheet right here, right now. And we had to do a deep dive into that, and that really sort of, accelerated our sort of look into this as a group finance function. And it really is about, again, that clear, controlled, concise message. And I think control is so important around this. You can fall into the trap, I think, of answering every single question you get from an NGO or anyone that asks, or you can give clear information which you can refer back to a golden source, like your annual report, which is really what we're trying to do as group finance, is get golden source information, annual report, TCFD. If you have other information such as CDP that you give out to the market, you should refer back to that information, and sort of not have ad hoc, non-public information going to the market. But also sort of the quality information means that if you give things at a shorter timeline, it often obscures the truth. Where you think about financed emissions, we're on a pathway to 2050. If you give updates every month, that'll be lumpy, and people will not understand where you're going on a journey. You may refinance a big client and sort of everyone's saying, why are you suddenly financing oil and gas again? So basically we elbowed our way in, we elbowed into, I guess, the sort of the communications team, brand and communications. This now firmly sits within the remit of sort of risk and finance, and we have a new chief sustainability officer who's joining today. So it really is CSO, risk and finance, which have taken the lead on this whole process.
Thank you, Mike. And then just following on from that, Supriya, so that obviously there's that nice kind of multidisciplinary kind of approach that needs to happen. Can you tell us a little bit from your experience of how that's worked?
Yeah, I think it's really important to have all the areas involved to make this successful, because we in finance can kind of, work on the numbers and get an answer, but what does that answer mean? What does it mean for the business? What does the business do with it? So I think another player that we have wanted to make sure we involve in the journey is actually our business teams, as we have gone through it. So our main players in terms of this work have been finance, our Climate Centre of Excellence, who provide us that expertise from a climate perspective. Legal, as I said, just given the level of caveats we're all having to make, as well as risk and the business. So that's kind of the team. In terms of the buy-in within finance, as you mentioned at the start, the CFO network. So our CFO is quite engaged in that, and obviously kind of up the curve in terms of where we need to get to and how do we see climate as one of the key metrics. So I think Mike mentioned this is the new ECL, so there's a lot of conversation. Is this the new RWA and all those sort of things? I think what we are working on is making sure the organization internally understands climate and how do we improve climate in our decision making. So there's a lot of work going on that as well.
Thanks, Supriya. And then moving on to a couple of other questions that have come in, and this is for Supriya. Can you tell us a little bit more about whether subsidiary reporting is an issue that you have come across in NatWest, the subsidiary pathways and emission share?
I think at the moment we are obviously focusing more on trying to get a group view. So we're working with NatWest Group as a whole, but I mentioned we're trying to develop our internal thinking in terms of how do we think about climate. And as we are doing that, we are working with our subsidiaries and franchises. So we've got like NatWest Markets that looks at the investment side, and commercial that work with the commercial customers and retail. So we are working with our franchise teams as well as with legal entity lens to develop that view. So that's something we're working on internally, but from an external perspective, focusing on group just now.
Okay, thank you. And a question, I'm just jumping from either or both so I can ensure that as many of the questions that we're getting through are covered. Regarding ESG reporting, Mike, how do you work what kind of practical steps are you taking, or top tips do you have around the streamlining of ESG reporting across 57 markets? What are the kind of practical actions that you're taking to kind of navigate through those kind of obstacles and challenges?
I think probably the first one is acknowledging it as a challenge. But generally, as Supriya said, we are taking a group view. So it is working out the group position on a consistent manner, working out what that group position is, which involves basically your loan portfolios across all of your regions. But then also where you have things like basically feed in of new ISSB standards, where you have things like UK Finance or other AFME sort of group organizational meetings, it is spreading the message, having a central team which basically provides the bank's views, and then disseminating that down through the organization, so to your country CFOs. So it's consistent application at group and consistent message at group, which then sort of permeates down through the organization. And I think it's that consistency that's key. Again, it goes to sort of what I've tried to bang on about, which is a simple, concise, and controlled message that sort of you stick to, and where you have to deviate. So where, for instance, data improves and you have a change in estimate, it is the clear and concise sort of disclosure and definition of that change.
Yeah. Okay. And Supriya, do you have anything that you wanted to add on that point?
I think we probably aren't as complex as having 57 areas to deal with, but I think we're sort of complex of being quite big, obviously, in the UK. And so I think it's that awareness point internally, because once we make people aware internally, like Mike said, in terms of speaking to the geographic CFOs, etc., and then what does it mean, and then how do we bring the finance discipline to any disclosures we get? Because once you tell people, everybody wants a lot of information in our climate report or our ESG supplement, but how do we filter out what is really necessary? And I think that's where the new standards like ISSB or other kind of common standards, once we have them, would be really helpful to guide as to what should the content of these reports look like and what's material, etc. So there's work going on that as well.
Okay, great. And just talking about the ISB consultation, this is a general kind of call out to all organisations to really have their say and participate in the consultation, because it's extremely important, which I'm sure you all agree. So I have one more question here for Supriya. What is NatWest thinking about undrawn or uncommitted finance submissions? So you've mentioned that already in your presentation a little bit. Do you have any more details that you can relay on this?
So as I mentioned, PCAF currently recognizes on balance sheet sort of related emissions, and that's what we have been working on so far. But I think internally we recognize the shortcomings in terms of that may cause variances as customers draw down. So I think that work, we are looking to see how we could use our existing methodology to calculate that, and also liaising with kind of industry peers to see how that may work. PCAF published a consultation last year or maybe early this year in terms of the underwriting and emissions related to that. So I think we're looking at that as well to see how we could approach that and work on that. So it's work in progress, and we are very much aware and thinking about it.
Okay, great. And just before we wrap up,
I might just add on,
sure,
if you don't mind, I might just add on that and just sort of, Brett, you asked this question. Keep things simple. You know, when you're building your models, keep things simple. Your drawn balance sheet equals basically your loans and advances to customers. Work out your finance emissions on a drawn basis. Work out your sort of EVIC ratios, carbon, forward-looking pathways. I always try to keep things as simple as possible. Like Supriya said, there's more guidance coming out on sort of underwriting and what happens there. People often ask about drawn or undrawn. Keep it on the drawn. I know there's a tension between your risk functions, which often will look on a total drawn and undrawn basis to be like a net nominal in finance. But my view is keep your message simple and then modify as you go forward. But a simple first message is the best in the market.
Well, you've anticipated my question then, because it really was going to be, what are the kind of takeaways that you would, or the top tips that you would say? So with Michael, it's keep it simple. And Supriya, anything that you would then say to our audience here?
I think I'll probably link in, but basically say don't be afraid to start. So data isn't perfect, methodologies are imperfect, but make a start. Because as I said, calculating emissions is the first step in the journey, and then it gets to what do we do about reducing emissions. So yeah, make a start. Don't be afraid to make a start is probably the strapline.
Fantastic. So keep it simple and make a start. So that's brilliant. It sounds like we're going into some kind of advertising branding here, but that's great. So thank you both, Supriya and Michael, for presenting to us so comprehensively on this. And as I say, this will be this recording will be on our website for you participants to share with your colleagues, because I think there's some super comprehensive information and detail that Michael and Supriya have very kindly shared with us today. So without further ado, I'd like to move on to our next part of our session and welcome onto the virtual stage Alex and Justine. And what we're doing here, we've brought both Alex and Justine to kind of deep dive a little bit more on the special or additional parameters that banks in emerging markets face. And I'd like to ask, so we're going to do a bit of a panel kind of session here. And Alex, with your kind of work with the development organization, it'd be great if you could tell us a little bit more about setting the context and the challenges specific to banks in emerging countries on this particular topic.
Thanks very much, Kerry. Yeah, so I'll make a few introductory comments, and then Justine can kind of take you into the realities of working in Southern Africa, and particularly South Africa. But the kind of basic setup here is, and Mike touched on this with kind of Standard Chartered's exposure in kind of 57 countries, but development finance institutions like BII, where I've worked. In fact, I've just this week stopped working at BII, but I can still speak for it. But the development finance institutions also have exposure to kind of typically 50 to 70 or 80 countries in Latin America, Africa, South Asia, East Asia. And although development finance institutions aren't big financial institutions, they typically have maybe 10 billion US dollars under management, but they do have a lot of exposure and multiple clients, both in the financial sector and also in the real economy. And so working out our own carbon footprints is quite a challenge, because we're so dispersed, we've kind of gone down a route of modelling, which I'll say a bit more about in a minute. But I think the observation we had was that kind of collectively we have probably 250 bank clients in emerging markets between the development finance institutions. And what we noticed is that very few of those banks are members of GFANs. Relatively few of them have become supporters of the TCFD. And actually relatively few of them know about PCAF or have joined up and made a commitment to do carbon accounting. But FirstRand is an exception because I think they've kind of signed up to everything. But if you think of a bank in Nepal, a bank in Ecuador, even banks in Egypt, they're not participating in some of the major global forums on carbon accounting. So our interest as development finance institutions is to help banks in developing countries participate, but also provide them with tools to, exactly as the previous speakers were saying, to get started, even using modelling as a sort of simple approach to get the first kind of footprint out and disclosed and get the debate going. And if you think that there are actually 3,500 banks at a conservative estimate in developing countries, the importance of that sector, nobody even knows what share of financed emissions those banks have, but I estimate it's about 10% of financed emissions globally. So it's not the big $1 trillion assets under management, the BlackRocks and JP Morgans. There's a lot of small banks, but as they say, 20 billion of AUM here and 20 billion there, it soon adds up to quite a lot of carbon. So getting these banks engaged and started and participating on equal footing with the big global banks, I think is really important. So I think that's the context here. We've been discussing with Justine a little bit about kind of how we can help, but they were already doing some really good work at FirstRand, so I'm going to pass the mic straight over to her.
Thanks, Alex. Thanks, Kerry. Hi, everyone. Yeah, so I just wanted to set a little bit of scene about FirstRand's approach to carbon accounting, financed emissions, as well as climate change. Our climate strategy the first being, a business perspective. So developing financial products and solutions that can help our clients with their transition and to mitigate and adapt to climate change. The second being financial resources management. How do you adequately price for climate externalities and benefits to appropriately channel financial flows and to enable positive and mitigate negative outcomes. And the third being a risk management focus, ensuring that the group's balance sheet is resilient against the impacts of physical and transitional climate risks. So my understanding, my feeling is that carbon accounting or financed emissions feeds into all of these perspectives in terms of managing climate change. So not just from a risk, but also from an opportunity and a strategy perspective. So to talk to FirstRand's approach to portfolio carbon accounting, it mirrors a lot of what Supriya and Mike have already said. Carbon accounting doesn't necessarily differ whether you're in a emerging market or other economies. The approach is similar. It's some of the other implications that then and other challenges that we have to bring into account. But really what we did is we focused on material and high impact asset classes first to apply the financed emissions methodology to, and those that there was more data availability for, because you've already heard from the other speakers how data availability is a big challenge. So we started off our financed emissions work looking at the mortgages, the motor vehicle finance, the commercial property finance, agriculture, as well as corporate and commercial loans, and the oil and gas books in our portfolio. Some of which we've made quite good progress on, and we did disclose sort of high-level results in last year's TCFD report, and we continue to improve on that. We do apply the PCAF methodology, and you've heard about that already, which looks at the emissions of the asset or the product or the client that you're lending to or investing in, and then it's applying that sort of attribution, the loan to value or sort of ratio based on your financing to that to see what you're responsible for. But again, like the other speakers have said, the main challenge that we've been experiencing is client level data is just not available for a lot of these investments or loans or clients or customers of ours. Obviously, it's a first prize to use that actual emissions data, but where not possible, we've had to use intensities and averages and rely on external sources and support like the PCAF emissions intensity database. And that's where our partnership with Jim has come in to run this pilot. We're also then relying on the joint impact model to help us look at specific emissions data that is relevant to the African region. For South Africa, I think we're a little bit more fortunate because there's a little bit more data available in terms of emissions averages and emissions intensities, but we found that there was a big gap when trying to look at the portfolios of our African subsidiaries. So that's where we're hoping that our pilot with the joint impact model can fill some of those gaps for us. But it's not just external challenges that are, external data that's a challenge. We also found that internally, even our systems, in terms of getting data from our financial systems, that was also a challenge for us. Initially, you've heard from the other speakers as well, the cliche of the journey. The first time we tried to do the calculated, the financed emissions calculations, we didn't really know who to ask for the data. The data wasn't really available, coming from the finance and credit teams. But by just going through that exercise, we've already identified how to improve our systems, how to improve our internal data capturing, how to fill some of those gaps, how to start getting more client level information that can feed into our calculations and actual emissions data. So that's already been a positive outcome of having started this journey.
So
yeah.
Justine, can I just dive into a little bit about the engagement then with the finance team on this? Because obviously you
Sure.
sit outside the finance team on this. So how have you brought them into this, and how have you kind of encouraged a kind of multidisciplinary kind of approach around this?
Sure, thanks, Kerry. So yeah, so I'm based in the risk function, and we report to our chief risk officer, who is sort of responsible for climate risk throughout the group. But really what we found is that the climate work and also focusing on the finance and emissions work is a group-wide collaboration in terms of getting the loan book data, getting the credit risk modelers to start modeling this data, putting it into their credit risk models. We've drawn from data analysts across the group. In particular, the emissions accounting utilizes the financial exposure data, so we're having to rely on them to draw the data and send it through to us, and enhance their data capturing capabilities in their system to start reporting this. So yeah, I think what I'm trying to say there is that it's a multi-disciplinary, group-wide collaborative effort across all the functions to get to not just the finance and emissions sort of pieces, but to build up the whole climate change picture. I think also what's important to note, there's the regulatory requirements. For example, the BCPS 239 has led to a closer alignment between the risk and financial data across all risk types. So we're finding that there's an increasing use of the shared data warehouses and shared data. We're looking at automating some of our data platforms so that we're all working off the same data sources when reporting into the various data streams, that we're all working off singing off the same hymn sheet, so to speak. And then also in terms of those the IFRS sustainability disclosures recommendations that have already been mentioned, I think that's going to lead to even closer alignment going forward about the data that we work with and the data that we draw from and how we report this going forward. So yeah, I hope that answers your question there, Kerry. I mean, it's it's not just it started off in the risk function, but now it's become very much as well a part of business as usual. Everybody is working with this information. They're using the data and they're building it into their business as usual function, so that climate is integrated across all risk types, but also into the products and solutions and the financial resources management, and as those considerations are becoming sort of part of business as usual.
Has there been like a need to or an opportunity to bring? I'm just thinking about the culture within an organisation and how they get buy-in across different. When you're looking at a multidisciplinary approach, how you get buy-in from different organisations. Did you decide as an organisation to invest in training, or was it more kind of organic than that? What about the tone from the top on this? I'm just thinking about getting started, getting that kind of buy-in to say we need to doing X, Y, Z above the kind of compliance side.
No, absolutely. So as I mentioned, we sit in risk and we report to the Chief Risk Officer, who is responsible for climate risk, but actually also feeds into the high level. So I think governance is very important, and the governance structures responsible for climate change. So at First Rand, we feel very fortunate that climate change, both risks and opportunities, are taken seriously and considered at the highest level. We've got a climate change steering committee that feeds into board level committees. There's standing climate agenda items on these board level committees. We've got representatives on the board with background in climate change and other environmental matters. So it's really coming from the top that's setting the tone, and that helps to integrate it right down throughout the business. In terms of training, those that are familiar with the TCFD recommendations will know that training is one of the recommendations or the suggestions that the guidelines ask about. So we've had board level training on climate change to capacitate the highest levels on what climate change is, climate change risks. So just to sort of raise the awareness at those top levels to help drive it down. And then we've also integrated climate change training, general climate awareness across all of our employees in the group, and then are developing specific, little bit more in-depth climate change and risk management training for the risk professionals. So we're trying to build the capacity and build the awareness throughout all levels of the group, so that it can, when it is business as usual, that everybody is capacitated and everybody's on board and everybody's excited and everybody knows the impact that it can have.
Okay, thanks, Justine. Just going through some of the obvious challenges that you're facing, I wondered between you and Alex whether you could talk through how you're approaching that at the moment.
I think, yeah, I mean, I can speak to the specific regional challenges, as I've mentioned. I think it was also brought up in the previous speakers. You know, as an emerging economy, our context is slightly different. We are, you know, we're a coal-based economy here in South Africa. The just transition is a very important concept for us, and it's not just you know, how to get to net zero. It's how to get to net zero, considering that the economies that we have and the societal impacts that a transition away from some of your high-emitting sectors will, yeah, the societal impacts need to be taken into account. So firstly, but again, I mean, firstly, it's to understand where those high emissions intensities are in these economies, and that's where the financed emissions part of the conversation comes in. How do we set that baseline? How do we measure where we are so that we can sort of plan a path going forward? Again, that's where our partnership with Alex and the joint impact model is coming in, is how do we start looking at this from a regional perspective, from our African subsidiaries? How do we apply appropriate metrics and emissions factors, and how do we model it appropriate for those contexts? So we're hoping that the GIM model can support us in that. And then I think it's also important to bear that in mind when setting those net zero aspirations and those targets and those trajectories of how we're going to get there. We don't have those answers yet, but we know that we need to consider it. From a first-hand perspective, emissions intensity certainly allows us to identify which sectors we need to focus on immediately, and how far we have to go, where we need to get to. We need to set emissions intensity-based decarbonisation contexts that are relevant to both our country's national determined contributions as well as those just transition pathways. We've actually been working as well locally, or we're part of the broader working groups of a National Business Initiative Just Transition Pathways project, where business is looking at various sectors within our economy and what they need to do to transition to net zero, but taking that just transition into consideration. So looking at the jobs impacts, looking at the socioeconomic impacts and effects as well. And again, going forward, that's where we're hoping that through this work with the GIM model, we can bring that kind of jobs link and thinking into it as well. Alex, I don't know if you want to speak to that a little bit more.
Yeah, very happy to. Thanks, Justine. Look, so we've kind of mentioned a couple of times the joint impact model. A little bit of context. This model actually was kind of pioneered by Standard Chartered Bank with a boutique consultancy called Stuart Red Queen back almost 10 years ago now, for kind of working out what is the impact of a bank in a country on the economy in terms of GDP contribution, but also in terms of supporting jobs in the economy. So the development finance community kind of jumped on that work and developed it into a systematic tool, initially for jobs accounting, as a kind of positive impact of development finance in developing countries, and then kind of realized 2 years ago that actually you could apply the same input-output approach of modeling financed emissions to GHG just as well as you could to positive impacts like jobs and contribution to GDP. So we partnered with PCAF, that we've mentioned a few times now, the Partnership for Carbon Accounting for Financials, to align the model. There was a few kind of tweaks that needed to be made so that it would align to the quality levels that Supriya talked about in modelling. You know, we wanted to make sure that these results, even if simple, were at least kind of on the quality scale for PCAF. And I think the kind of key thing that Justine mentioned there is that a typical bank, I would say anywhere, but maybe particularly in developing countries, has a sort of national mission to kind of promote economic development, SDG 8, you know, goal, jobs and growth, while also getting onto a credible net zero pathway. And I think more than banks in OECD countries, that kind of dual mandate is really important. And so we do see a value of toggling between GHG emissions and job supported sector by sector for a bank. But we also recognize that even sophisticated banks like First Rand, if I can call you that, Justine, you've got nine subsidiaries outside South Africa, and your data is patchy there. You don't necessarily know what the exposure is of those subsidiary banks sector by sector. So kind of this principle of kind of keeping it simple. I think it was Einstein who said everything should be as simple as possible, but no simpler than that. And so getting it right so that First Rand can know what its exposure is in Madagascar and Nigeria as well as South Africa, even if that's the last 10% of emissions, it's still useful to get that on the map for completeness sake and measurement sake. One thing we've found in the development finance community, and we may, this may not apply to commercial banks, but we've found that the carbon accounting process of going through client by client and assembling the data as inputs into the model has actually been incredibly helpful as a collaboration between investment teams, finance team, and the impact team. And that actually there's been some surprising gaps in the data quality on the financial side. And so this has been partly an exercise in good housekeeping to fill in gaps where you might have expected there to be good data, but actually for one reason or another, there wasn't reliable data on client revenues, basic client information, location of clients, their exposure country by country. So coming at it with a carbon lens has actually improved financial data in development finance institutions. Now that may also apply to some banks. I think the other thing I'd say is that, obviously every country is different. If you're juggling with 57 countries like Standard Chartered, that's a headache. I guess NatWest has a significant exposure in developing countries as well, even if most of its stuff is focused in the UK. But when we talk to a bank in Kathmandu in Nepal, they're working with PCAF and they're saying, well, it's okay, but we're getting emission factors that are kind of what they call rest of Asia. And rest of Asia basically means Vietnam, because that's the dominant economy in rest of Asia. And as you'll know, Vietnam is 90% coal-powered economy. And you probably also know that Nepal is 90% hydro-powered economy. So to use a essentially strongly Vietnam-weighted emissions factor for Nepal is too simple. And that's what I say, don't make things so simple. It's much better for a Nepalese bank to try and get emissions factors based on Nepal rather than relying on what's so easily available for the rest of Asia, because they're going to be way out if they rely on those factors. So the conversations we're having over the next 6 months with banks will be to try and delve into this and to make sure that there is an available model to help all the banks get started on their journey. Once you've got started and done some disclosure and got comfortable with the systems and got your sectors all lined up, talk to your central bank, talk to other banks in your country, then I think you'll start honing in Pareto principle on the 20% of clients that have 80% of the emissions, but those won't all be in the obvious sectors. And I think what Supriya showed from NatWest in terms of the agriculture sector is one that I think a lot of banks find surprising, is how big emissions are from the agri sector. But there'll be a bunch of sectors that kind of come up as being unexpectedly high emitting. And some of those sectors will also be very high job supporting as well. And so there'll be kind of particular strategies that banks will need to consider, I think, in terms of decarbonising those sectors without destroying a lot of jobs, because that will put them in the hot seat in terms of kind of public policy in the countries. So those are a few of my observations. But Justine, I'd be interested to, my kind of findings from the development finance side about kind of carbon accounting helping drive up data quality across the whole business, whether you've had that experience, and maybe Mike and Supriya, you could comment as well from the kind of even more sophisticated Standard Chartered and NatWest.
Yeah, certainly on our side. I mean, we started with our South African loan book, looking at the hotspots and the data availability there. But we've been quite considerate as well about bringing our rest of Africa subsidiaries along with us on the journey. So they're not far behind in terms of getting this data. They've been able to, I think, leverage a little bit off the lessons that we've learned of where to look, who to ask, what kind of data needs to go into the calculations. But I think, yeah, having had a little bit of guidance from us in terms, from the South African loan book and the systems, it's been helpful, but they're not far behind. So we're bringing them along on this cliche journey with us, so that we can get that comprehensive picture as well. I think it's also surprising to know that they are, even though the regulations in some of the rest of the Africa subsidiaries are slightly different, some are also quite far ahead in terms of their climate regulation and climate considerations. So they're at various stages, some more advanced than others, but everybody understands the importance and the need to get to grips with yeah, they're coming along on the journey with us. They're not too far behind.
Okay, and Mike and Supriya, was there any comments you wanted to make to Alex's question? Alex, you might want to repeat it.
No, it's just whether people have found the experience of doing carbon accounting has helped with general data quality inside the bank. Or whether it's kind of just an additional task.
I think, as I mentioned, there's climate-specific data that's needed, obviously, because we haven't been gathering customers' emissions before. We do gather EPCs, but we probably weren't paying as much attention before than we are now. So yes, where there are commonalities, and I mentioned we sometimes use production and revenue data. So when we did impairment calculations, we do look at customers' financials. We look at it from a different lens in terms of the stability of their book, etc. Whereas it's for a different reason now. So I think where there are commonalities, we have definitely we are now making sure that we add climate in the use case and make sure the elements we use are right. And where there's absolutely new data, then obviously we are having to develop a new control framework. But yeah, it will, in my head, climate data will be an extension of our regulatory and financial data. So absolutely the same discipline, and I think they all need to talk to each other at some point as well.
Yeah, that sounds right.
Just to add on there, and I think I referred to it earlier as well, is that we're on this big drive for automation, so that we're bringing this data into a central platform again, so that everybody can leverage off the same information and it's accessible for various functions across the group. So I think that's also been quite a benefit for us in terms of automating the systems. It improves the data quality and data capturing, but then it's a central place for everybody to leverage off and reference. So we find that quite useful as well.
Oh, Alex, you're on mute.
Harry, if I may, maybe make one other observation based on a discussion with the bank in Quito in Ecuador on the other side, and there the kind of the carbon accounting lead said to us, well, we've started on vehicle finance and mortgages. And we're making good progress on that, and I said, oh, that's interesting. So is that the main focus of the bank? And he said, no, not at all. No, that's kind of hardly any of our business, but that's the bit where I can get the data to do the accounting. He said, I think that's probably less than 10% of our loan book, but it's the bit where I can find the data. So this kind of old analogy of kind of looking for your lost car keys under the light, the kind of street light, I think does apply for carbon accounting. So it is good to start somewhere, as we've said, but it's also good to recognize what the limitations of your first exercise are. And kind of the proposition there would be, that's fine, so to do a data rich exercise on, essentially quite an immaterial part of your portfolio, but then also find a way to make some progress, even without rich data, on the 90% of the portfolio that isn't in those sectors where you can easily get hold of good input data. So I think it's a sort of balance of, you know, keeping everything in proportion. And I really appreciate the NatWest, the sort of getting to over 50% coverage quite quickly, and Standard Chartered, I think, Mike, you said 77% coverage quite quickly. And I think, you know, my prediction would be over the next year or two, but not more than that, that there'll be quite a lot of pressure for banks to be getting towards 90+% coverage of their whole portfolio financed emissions, using kind of level 5 PCAF quality just for completeness sake. I think the kind of, you know, the kind of greenwashing kind of push that's on very strongly now onto the financial sector will mean that kind of, you know, working slowly through this won't seem fast enough. So kind of a bit of speed, even with kind of lower data quality. And I think other speakers address that kind of, that need to kind of get moving and then kind of bring up quality later. I think that is the right message.
And we found collaborative partnerships very helpful to help us with that as well, with that learning. So I mean, we do look to the NatWests and the like, you know, for inspiration and guidance on what they're doing, because they're ahead of us in the journey and they've published really good guidance. So I mean, that's definitely helped us, and then it's through these partnerships like PCAF, like through this joint impact model, it's through regional collaboration where you share messages about regional challenges and sticking points that you have. That's where we find it helpful to move on with our journey as well, and solve these challenges together and learn from others in the field. So that's one way that we're looking to improve.
Brilliant. So we have just start, keep it simple, learn from others, and there's a lot of work that we do in collaborating those peer experiences. Alicia has just dropped into the chat the guide that we did, and we've also got some case studies around this area. And then from Alex, it was keep it proportionate, but do it speedy. I think so.
I'd probably just add, sorry, just one more thing. It's also just keep the communication with your banking peers. You know, sort of we're all on this journey, and I know we've used journey a lot of times, but you know, we're all on this journey. There is like the Net Zero Banking Alliance. We all have the same questions, and at the end of the day, the market wants us to produce comparable information. So you can agonize which forward-looking pathway am I going to use. At the end of the day, if 10 banks sit down and say we're going to do this one, maybe it's not the best by science, maybe it's the easiest to understand, just use that one. Like, I mean, sort of keep things simple, keep them consistent.
Great. Thank you very much. And thank you so much to all our speakers today. It's been so much information to take through, which is it's a good job that we've recorded this, and we will be communicating it out to everyone.